Today, we are going to discuss about business finance from the subject of corporate financial management. A new or growing business may need a substantial amount of money to meet its all sorts of requirements for the smooth running of its business activities and for its long run stability. Each and every activity will begin with cash and end with cash, since money is the medium of exchange to deal with all economic or financial activities. Finance. The word finance derives from Latin word finis, Old French word fin for fine, which originally meant end. The French word for finance came to mean both payment and ending. But in the 18th century, the English adapted it to mean the management of money. Finance may be defined as art and science of managing money. Also is referred as the provision of money at the time when it is needed. Finance is the lifeblood of economic activity. And finance is the lifeline of any business. There are different types of finance there that we will discuss about here. The first one, business finance. Next, direct finance. Then indirect finance. Then public finance. Then private finance. Then personal finance. These are the different types of finances there. Business finance. It deals with financial decisions taken by business organizations. It includes capital budgeting, the decisions related to the investment, capital structure, decisions related to debt and equity, working capital management, dividend decisions. For example, a company deciding whether to purchase new machinery or lease it. There also we can call it as the business finance for the company. First, we'll see direct finance. Direct finance is a system in which borrowers and lenders deal with each other directly without the involvement of any financial intermediary, like banks. How it works? Funds move directly from the savers to the users through financial instruments such as shares, bonds, and debentures. Examples: a company issuing shares to the public through an initial public offering. A company issuing debentures or bonds to investors. The main features: there is no middleman involved here, and it is used mainly for long-term fundraising. Indirect finance. Indirect finance is a system in which financial intermediaries collect funds from savers and lend them to borrowers. How it works? The bank or financial institutions acts as a middleman between the two parties. For examples, bank collecting deposits from people and giving loans to the businesses. Insurance company collecting premiums and investing the funds. Mutual funds collecting money and investing in shares or bonds. The main features of indirect finance includes there is a presence of middlemen and mostly used for short-term and medium-term finance. What are the differences are there between direct finance and indirect finance? Direct finance, funds flow directly from savers to the borrowers. In the case of indirect finance, funds flow through the intermediaries. And in the case of direct finance, there is no middleman present. But in the case of indirect finance, middlemen are present, like bank, non-banking financial corporations, mutual fund. And the instruments which is used in the case of direct finance are shares, bonds, debentures. In the case of indirect finance, it is in the form of loans, advances, credit. The cost of direct finance relatively less compared with the indirect finance. But in the case of indirect finance, the cost is high because the intermediary, we have to pay certain payment. And there is higher risk for investors in the case of direct finance. But in the case of indirect finance, lower risk for the investors. For example, buying shares of the company is called as direct finance. Depositing money in bank is called as indirect finance. Next one, public finance. It deals with the income and expenditure of the government. It includes taxation in the form of direct and indirect taxes, government budget, public expenditure, public debt, etc. For example, government collecting GST and spending it on roads and hospitals. That is called as public finance. Next one, personal finance. It deals with the management of an individual's or family's money. It includes income planning, budgeting, saving and investment, insurance planning, retirement planning. For example, a salaried person investing rupees 5,000 every month in a systematic investment plan. That is called as personal finance. Next one, private finance. Management of finance by private individuals and private sector institutions as opposed to government. That is public finance. It includes financing done by private parties, and focus areas are finance of private companies, private investments, private lending and borrowing, capital raising by private firms, private equity, venture capital. For example, a private company raising capital through private equity or banks, or private institutions giving loans to individuals. That is called private finance. The key differences between the personal finance and private finance includes individual or household money management is called as personal finance. Finance managed by private individuals, firms, and institutions is called as private finance. Personal finance focus on budgeting, savings, loans, insurance, investments. Private finance focuses to raising the funds, private investments, private sector financing. In the case of personal finance, the users are individuals. But in the case of private finance, the users are individuals as well as the private businesses. For example, the case of personal finance, budgeting your salary. In the case of private finance, a private company raising bank loans. So these are the differences there between personal finance and private finance. We'll see business finance. What do you mean by business finance? Business finance is the business activity which is concerned with the acquisition and conservation of funds in meeting financial needs and overall objectives of your business enterprises. And it is defined as the activity concerned with planning, raising, controlling, and administrating of funds used in the business.